And if you don't believe it, just look at the debt. Ask yourself, are we in the largest debt bubble in history? And I think undoubtedly you will tell yourself, yes, we are. The point about debt is the other side of debt is credit. Debt equals credit. So if we're in the largest debt bubble in history, we are in the largest credit bubble in history. Credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. I mean, I've been writing for some time that the real danger is we are in the largest credit bubble in history. And if you don't believe it, just look at the debt. Ask yourself, are we in the largest debt bubble in history? And I think undoubtedly you will tell yourself, yes, we are. The point about debt is the other side of debt is credit. Debt equals credit. So if we're in the largest debt bubble in history, we are in the largest credit bubble in history. Credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. On top of that, we have tariffs. The tariff agenda is lethal as far as the credit bubble is concerned. It is exactly the same dynamic that we had in 1929 to 1930 when we had the popping of the Roaring Twenties credit bubble. We had the Fed, it was the first decade of the Fed with Benjamin Strong. And he believed in if you like, credit expansion to drive the economy. So, that's not too far different from current beliefs. On top of that, we had the Smoot-Hawley Tariff Act, which increased tariffs by an average of about 20% or slightly more. Now, in those days, I understand that consumer goods imported from abroad accounted for no more than 2 or 3 or 4% of total GDP. This time it is different. It is considerably more. The consequences of Smoot-Hawley Tariff Act Mark II are considerably greater than first time round. Not just because of the increased volume, if you like, of imported goods into America. Also, we have supply chains across the world which are affected by this. We also suspect, and the rhetoric has very much confirmed this, that other countries will respond with tariffs of their own. So we have this situation. I have no doubt at all that the EU will do just that. The UK is sitting on its hands trying to pretend that there is a special relationship. We have been treated better by Trump with 10% tariffs as opposed to the EU, which is, I think, 20% tariffs. And consequently, we just don't want to shout about our position too much because we don't want to upset President Trump. So, but going back to the point, the combination of a credit bubble bursting and tariffs on top were what drove Wall Street down from the highs in September 29 to the lows in 1932, middle of 1932, whereby the Dow lost nearly 90% of its value from top to bottom. And on top of that, we had about 9,000 banks going bust over that time and following that time. And, people say, well, the problem with the reason we had a depression was because of the contraction of money supply. What they failed to understand is the reason that money supply contracted was because banks went bust. It's the only way in which bank credit gets removed, if you like, from the economy, by banks going bust, or alternatively, people who owe debt to the banks going bust. Then it gets wiped out. It's as simple as that. But until then, what happens, and particularly since we don't have a gold standard of any sort, is that credit just gets passed on. But that's a slightly separate, I'm going off topic going in there. But the point to understand is that we have a combination of the largest credit bubble in history going pop and Smoot-Hawley Tariff Act Mark II, courtesy of President Trump, at the same time. exactly the same dynamics, but worse than we saw between 1929 and 1930. And that's why, we're seeing today, I mean, I'm just looking at my screen here, we got, the sort of NASDAQ down 5%, and we've got, all these things are just falling apart now. And the idea that this is a sort of little bit of turbulence and don't worry, it'll sort itself out, I don't think so. And we can also talk about interest rates if you want to come onto that subject at some stage. If you look at the UK, the main members of the EU, with the exception of Germany, we're all in debt traps. Now, basically, a debt trap is where the government debt increases at a faster pace than the revenue that it gets in. Yep. If we go into recession, slump, depression, whatever you want to call it, tax revenues drop, welfare commitments rise, budget deficits increase. So you have this situation where tax revenues are decreasing, but the creation of debt is increasing at a faster rate. In other words, we have a debt trap, okay? Now, so you've got to think, what are the foreigners going to do with you on a debt trap? Now, whether it's you in the United States or you in France or you in the UK or whatever, it's all the same thing. They're going to look at this and they're going to say, hold on a minute. There is a lot of risk in me holding this currency. This currency is going down. This sucker is going down. Do I really want to hold it? And the answer is no. And that's why we're seeing central banks buying gold. I think the point to understand is that what central banks are doing is not buying gold. They're getting the hell out of credit. That's actually what they're doing. They realize that there are increased risks holding fiat currencies. So they are adjusting their reserves to reflect their perception of that risk. And this is something which has only just started, in my view, because really, another way to put it is that you could say that, paint great pictures and say, well, we had Bretton Woods. That was chucked out in 1971. We then had the fiat currency era. That's now coming to an end. We're now going to have a new monetary system, which will replace the fiat currency era. Question, what is that going to be? Answer, we don't know. And it's particularly difficult because the whole of the West is stuck, if you like, on the idea of macroeconomics, neo-Keynesianism, the idea that the government has got to continue to stimulate the economy for the economy to grow. What is economic growth? Well, it's a complete non sequitur because you can grow the economy, but the GDP number is basically the amount of credit which there is in the system. It doesn't tell you what that credit is doing. So actually, I mean, the problem we have is that the guys monitoring this, their use of statistics and all the rest of it, is completely useless. They don't understand economics. They don't understand what they're doing. So how they're going to come up with a new system when they don't actually understand what they're talking about, this is going to be an interesting development. So, and I would like to mention something else. I mean, we see that central banks are selling dollars, selling euros in particular, and for all I know, selling sterling. They should be selling sterling, selling yen to buy gold. Okay. Gold is, if you like, their safe haven. I can understand that. I think we should all be able to understand that. But what does this mean for interest rates? Well, if you have a heightened risk in a currency, then quite obviously, I mean, by risk, what I mean is a risk that it will lose purchasing power, then the interest rate, which you as a foreigner would accept, if you like, to continue to hold that currency, should reflect your view of how the purchasing power of that currency is likely to go down or up or wherever it might be. There is absolutely no doubt that anyone holding a foreign currency is looking at that foreign currency and thinking, I'm not going to get as much real value, if you like, in a year's time as I have now. So the idea that the Fed can reduce interest rates, for example, and manage the economy and all the rest of it, and even, sort of reduce interest rates so that all the zombie corporations who would go bust with interest rates of, say, 4, 5, 6, 7, 10% are miraculously rescued. That's not going to work, because what will happen is that the foreigners won't hold your currency. They'll sell it. And that's what we're seeing today. I think the dollars trade weighted is down 2% or slightly more than 2% in one day. This is a major move. Mm-hmm. So, how do you counter this? Well, the answer is you've got to have higher interest rates. Interest rates are compensation for risk. It's risk at loss of value. And this is a point that nobody seems to understand. They seem to think, and this is Keynesian groupthink, basically. They seem to think that if we go into a recession, then interest rates go lower. No, they don't. Interest rates have got nothing to do with recession or growth or whatever. It is far more to do with the anticipated purchasing power of the currency, let us say, in a year's time. So if the anticipation is that the currency is going to lose more value, let us say, than the market expects, then interest rates are going to go up. Bond yields are going to go up. Nobody's going to lend you money, particularly if you're in a debt trap, anything like current levels. And as to the point, we had exactly this problem in 1976 in the UK, because first of all, it started with the sterling crisis, and the Americans came and bailed us out. They bought sterling, drove it up, and then they sent in the IMF, who, of course, they controlled and they still control, sent in the IMF basically to get their money back. And the IMF forced the UK government to do something about their spending. And left-wing ministers were resigning left, right, and centre, Michael Foot being the most prominent one amongst them, Tony Benn being another. They couldn't take this cut in public spending being, basically somewhere between socialism and communism. But the point is that at that time, gilts were issued with coupons in excess of 15%. They were yielding as much as 16%. I can remember the 15.5s of 98. This was issued, I think it was in either 1975 or 76. So, that's the proof that if you've got a currency risk, then, nobody is going to lend you any money at all, any credit. Nobody's going to give you any credit unless the return is there to compensate for the risk. And here we are now going into debt traps. Where's it going to stop? Don't ask me. I think it's going to be a lot higher than current levels. So what we have seen today in terms of shifts within the market is we've seen a sort of developing collapse in equities as the bubble pops. At the same time, bond yields have fallen quite heavily, I think because of this neo-Keynesian misconception, partly, but also in anticipation of investment managers rebalancing their portfolios away from risk into what they perceive as no risk, the regulator will tell you that US Treasuries are no risk at all, which of course is a complete nonsense. But as if you're a fund manager, if you're an investment manager, this is the sort of thing that you consider. So, we've got markets beginning to anticipate a rebalancing of portfolios, which basically is going to undermine equities even more. But there will come a point where the perceived benefits to bonds in terms of falling yields are going to be reversed when people do this double take and say, hold on a minute, what does this mean for the dollar? What does that mean for interest rates? And then you will find that yields will start rising. And that will be, if you like, the second knock on the equity market. And this is what happened. This basically is what happened way back in 2930. You had the initial fall. You had, sort of Black Monday, Black Tuesday, whatever. You had the fall, really dramatic fall in October 29. It then steadied from, I think, early November through to around about, from memory, something like May, 1930, around about then. And then it was, just a straight slide, just going down and down and down and down until the whole thing bottomed out in 1932, mid-1932. I can see that we can have an initial sell-off. I think we'll probably have some sort of consolidation. But then when people actually realize that, the consequences of the debt traps that everybody's in, I think at that stage it's really going to go, really going to go down. And of course, we don't, as far as the banks are concerned, we don't only have commercial real estate, but, there's an awful lot of equity, if you like, which secures their collateral. And, here again, you're going to get selling by the banks, forced selling by the banks in order to protect their own position. The interesting situation is what's going to happen to the residential property market. And, there you're going to see mortgage rates rise and people will not be able to afford their mortgages. And not only that, but unemployment will be increasing. I mean, this is a hell. This is absolute hell. The political imperative is that the Fed, the US Treasury, and so on, and of course their opposite numbers in other countries, can't just stand there and watch this happening. They're going to have to intervene. And intervene they will. They will do what they can to, stop property foreclosures on people, et cetera, et cetera. So all that's going to happen. And all it'll do is just undermine the currencies even further. I'm afraid. I mean, what they used to do before 1929 to 1937, 8, whatever, was government took the view that, when you had this sort of credit cycle going pop, don't get involved, stay away from it. And for example, the First World War depression, I mean, it was very sharp and very nasty, lasted 15 months because government knew, don't get involved. Let them, just let people sort themselves out. And, so what happened was that capital got redeployed from things that were going bust into things which were, might do well in the future. But the only people who could take those decisions were entrepreneurs who knew what the hell they were doing, not government ministers. And then Hoover comes along. He was, I think, business secretary to Silent Carl Coolidge. Carl Coolidge said, that man is always giving me advice and all of it's bad, or something to that effect. And of course, he then became president following Coolidge, and it was a disaster. Then you had Roosevelt following him, and Roosevelt was doing exactly the same thing, sticking his nose into every bit of business, the New Deal and all the rest of it. He was just doing exactly, what Hoover had been doing before. So ever since that, you've had this government intervention. The government knows best. The government has this political imperative to make sure that nobody gets hurt, that make sure that, and of course, this is now sort of morphed into, we need to ensure that prices continue rising at the rate of 2% so that consumers are encouraged to consume rather than save. I mean, come on. We have got a hell of a mess to sort out now. And this is, if you like, it is a 1 centuries old mess that's coming up to be sorted out. I mean, literally, this is potentially horrendous. I can't see how governments can stop it. I think anything they do will probably make it worse or prolong it. And worse than that, I can't see that anyone in government has the first inkling, if you like, of basic economics. They think in Keynesian terms, they think in macroeconomic terms, which is complete non-science. It's a socialist ideal, if you like. We can manage markets. No, you can't. And I'm afraid that the time has come for us to pay for all these follies.